Welcome to the course. Throughout the course, we will talk about the fundamentals, the crucial things you must know about the stock market, about the financial markets, some things you need to know in terms of personal finance, and we'll also talk about the basics of trading as well. So you're going to learn a ton throughout this course. I'm very happy to kind of take you on this journey. Just the fact that you're even willing to, pay for a course and further your knowledge is really a great sign, and I love to be working with someone like you. So with that being said, let's start it off with the basics of the equity and the debt markets. So everyone's heard of the equity markets, right? The stock market, right? It's just a group of buyers and sellers coming to prices on certain companies, right? I could say stocks there, but you're really buying a piece of a company. When you are buying a stock, you're not buying, a ticker symbol. You're buying a slice of that company. And then debt is just an instrument with a promise to pay back the money that you're lending out with interest. So corporations will really seek financing through two ways. The first is issuing equity, right, through the stock market. The second is issuing debt. So there's two real forms of debt, short-term and long-term debt. Short-term debt is treasury bills, commercial paper, and the reverse repo market. And then long-term debt is just bonds and other bonds known as debentures. This is a crucial part of the market. So the bond market is actually 3 times the size of the equity market. Typically, companies like to raise money through bonds more than they do through equity, right? Because when you raise money through equity, you're obviously diluting shareholders, and then through bonds, you're still able to keep your ownership within the company. You just obviously have to pay interest on that. And let's talk about a little bit more of the differences here. So stocks is just an equity ownership in a company, and then like I said, bonds is a debt instrument with a promise to pay back the money with interest. What you get on stocks is you get obviously share prices going up and down, and then you also get dividends, and you have voting rights within a company. And then in terms of bonds, you get interest as a return, and then you also get a return guarantee. So when a stock issues a dividend, they could stop that dividend at any time. But with a bond, you have a return guarantee that company must pay you back. The only situation in which a company won't pay you back for a bond is, if they go insolvent. And one benefit of owning a bond is you actually get paid out earlier than the equity holders if there is a bankruptcy, right? So let's say Apple goes bankrupt. Don't see it happening, but Apple goes bankrupt. Those bondholders will get paid out before the stockholders will. So by nature, stocks are more risky than bonds because in the event of a major recession and a bunch of stocks go under, well, those bondholders will still likely be made whole, but the stockholders obviously won't be made whole, and their stocks will likely go to zero. But there are benefits to owning stocks as well. So you have voting rights within a company. So if I own 10% of a stock, typically I own about 10% of the voting rights. And what do those voting rights do? Well, I can vote on different important things in the company, whether it's a new board seat and other things like that. You can vote for. Also, maybe share dilution. You can vote on that. So there's a lot of things that boards will put up for votes for companies, and owning stock gives you kind of a say in that vote. Bonds, you don't really have a say. And then let's just think about this fundamentally. So I really want you to hammer this in your brain. So let's say we're talking about one stock. Let's call it ABC Corp, and there are 10 shares of this stock in existence. There are only 10 shares. Let's say you buy 1 share of stock, ABC. You buy 1 share of this company. What is your percent ownership of this company? it would be 10%, right? So if you own one share in a company that has 10 shares, you own 10% of that company. Just trying to, hammer into your brain that you're owning a piece of a company here. You're not just owning a ticker. And that's why also the prices, when you consider what a stock price is relative to a market cap, you always want to be looking at a market cap when you're looking at what a stock is worth, because let's say I have 10 shares here, and each of these stocks are worth $100 each. That means the total market cap of this company is $1,000. But let's say I had each of these stocks were worth $1, but there were 1 million shares. The $1 stock is actually worth more than the $10 stock because it's about the market cap. Just one quick point there. And then just in conclusion, how do we make money with stocks? The first is dividends, right? We know what those are. Just basically a company making a commitment to pay you a certain amount, whether it's 3-4% of your original investment each quarter, right? So those are paid out quarterly, although they are listed on any exchange as a yearly number. So if you look at let's say Apple, they have a 4% dividend. That's not the actual number, just you using that for easy numbers. They have a 4% dividend. You would get 1% per quarter. So if you see a 4% dividend, that's an annualized number. Just keep that in mind. And then, how do you make money with stocks? Dividends, like I said, also share appreciation. What do I mean by that? I mean just you buy a stock at $10, it goes to $20, right? So that's simple share appreciation. I'll give an example here. So let's say I buy one stock this is actually a debt example. So let's say I buy one bond for $1,000. I get the bond. I'm on the left here. I get the bond, and the corporation gets the $1,000. What do I get in return? So in 2024, I'll get 10%. So this was a bond that had a 20% yield. So actually a 10% yield. So I'm getting 10% each year. So I will get 10% in 2024, 10% in 2025, and then in 2023, so I'm getting 10% per year. Once 10 years goes by, I get my original investment back. So that's just kind of an example of how a bond would work. And you can kind of see it year by year right here. So I'm getting 10% per year for 10 years. That's 100% total return. And I get my return of principal at the end as well. So I went in giving $1,000, and then I came out with $2,000. So that's kind of how bonds work. But there are drawbacks of bond and debt investing. So inflation is a big one. So you could, let's say I get 10% per year, right? But if inflation is 15%, then I'm losing 5% every year. So you got to always keep in mind what the real return of a bond is. So it's typically inflation minus the coupon rate minus what you're getting per year. That's the real return. So an example is if inflation is 5% and the coupon rate is 10%, you're really only getting 5% per year. So you always have to put those bond returns relative to inflation. Also, bankruptcy could still happen, right? You get paid out before the stockholders, yes, in the event of a bankruptcy. But at the end of the day, if the company goes to actually zero and it's really in debt and they have a bunch of other things that are messing with their finances, well, they might not be able to pay you back. So keep that in mind. And then you could also miss out on other investments. So this is kind of the catch-22 of investing safely, right? It's like when you invest safely, well, you could miss out on a bunch of other opportunities, although obviously you have that safety that bonds give. And how do you make money in bond investing? So you can buy and hold, and obviously, take in those coupon payments, or you could buy low and sell high. So what do I mean by that? Well, typically, I shouldn't say typically, but the bond market is just a group of buyers and sellers. That's all it is. Marketplace of buyers and sellers. So the price goes up and down every given day. So you could buy and sell bonds and make money. It's just not typically done as much. It's not like in the stock market, right? There's more people trading in the stock market than there are trading in the bond market as a percentage of total volume. Most of the bond holders, buy for the long term, and they buy and they hold throughout maturity, right? But how do bond prices move with interest rates? So they move inversely. So when interest rates rise, that means that bond prices are dropping. And when interest rates drop, that means that bond prices are rising. Now let's take a look at some portfolios and their historical performance when they're holding more bonds and when they're holding more stocks. So this screen shows me the breakdown of stocks and bonds. So the worst years of returns are on the left, the best are on the right. So let's say I have 100% in bonds and 0 stocks. Since 1926, what would my average return be? Your average return would be 5.3%. So that compares to the worst return of 8.1%. So, on average, if you have a 100% bond portfolio, you're going to have 15% of the years, or 15% of the time, you're going to be losing money. So since 1926, just to kind of flesh this out, 15% of the years we've seen bonds have negative returns. Since 1926, 28% of the years have been negative for a 100% stock portfolio. And then I'll go through each one. So let's talk about a 100% stock portfolio. So that's the bottom line here. So you can see 100% in stocks. The worst year for that was a minus 43% gain, or actually minus 43% loss. And then the average return is 10.3% for a 100% portfolio in stocks. And the best year was 54%. So if you want to take the stock route, you're going to have massive volatility, but on average, you'll do better than the 100% bond portfolio. And then really a typical allocation is actually a 60-40 allocation between stocks and bonds. So 60% being in stocks, 40 in bonds. And that has actually led to some pretty good returns. So with that portfolio, we can see that 8.8% is the average return of that portfolio. The worst year is minus 26%, and the best year is 36.7%. So the 60-40 portfolio only had negative years 23% of the time. So it kind of takes those returns of that 100% stock portfolio in the safety of the 100% bond portfolio, meshes it together, and we come up with kind of a happy median. So it seems like the best numbers are for the 60-40 portfolio. But if you were looking for pure gains, and like let's say you're a little bit of a younger person, it makes sense to have a little more stocks than bonds, and then vice versa if you're a bit older and you're closer to retirement. But we'll have a whole chapter on portfolio allocation to kind of break down what is the best allocation for you based on your time horizon, based on your time to retirement, and we'll cover that later in this course. So with that being said, I hope you enjoyed that chapter. Definitely make sure to go through the quizzes. Every single chapter we have here has a quiz at the end. Make sure you're completing those. It really is just kind of a good test on if you're retaining this information. If you do something if you get something wrong in that quiz, make sure you come back and take a look at this course just so you have it in your brain. I really want to build the foundation for your knowledge in these early couple courses, and then we'll build upon it, in the later chapters. So with all that being said, I hope you enjoyed this chapter. Make sure you do that quiz. I'll end it here.